Dzień dobry, Artur Wiśniewski z Stockbroker.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na panel dyskusyjny, w którym będziemy rozmawiać o inwestowaniu na rynkach zagranicznych i zastanawiać się, czy można na tym zyskać, czy stracić. Zapraszam serdecznie. Hello, everybody. Welcome to Passive Revolution Conference. Welcome Peter Garnry from Saxo Bank, Martijn Rozemuller, VanEck, Steven Santos, Steve Broker, and Nick Maggiulli from USA. Hello, everybody.
Hello, Artur. Good afternoon.
Hi.
Passive Revolution Conference takes place in Poland, a country with a really strong home bias, which is visible here on this slide. We can see that about 90% of equity portfolios of Polish investors are domestic stocks, so Polish stocks, mainly listed on Warsaw Stock Exchange. So we like our companies, we like Polish companies, we like Polish stocks, we especially like small companies. So the question is, what is the reason to go abroad with our investments? Is it a good idea at all? So maybe I'll ask Peter first to answer this question.
Well, one of the few things you get for free in financial markets are risk diversification, basically. So, and if you go from outside Poland and you go to an MSCI World Index, you will get a bit of risk diversification. You get exposure to more systemic risk factors in the world, more countries. So it is a good thing to think global, and especially in after 40 years of globalization, thinking global is a good way. So, but it is difficult to overcome the home bias for many investors.
Thank you, Martijn. Peter said diversification. What is your attitude to this topic?
Well, first of all, being Dutch, we always like a free lunch. And as Peter pointed out, I think diversification is probably the only free lunch you get as an investor. So to me, that would also be the most important part. I think also in the Netherlands, there's quite a huge number of investors that really like to stick to the Dutch companies they invest in, and up to a certain extent, that's not a big problem, especially not if these companies are internationally active. But I think as an investor, you should really be more diversified than just to invest in one country. So that would definitely be also my approach.
Nick, what would you say on that topic, especially because US was also on that slide, and it's a specific country because there's also home bias, about like 7% of portfolios are US, but it's a specific situation because US is one of the largest countries in the world, one of the largest economies.
Yeah, I think home bias is pretty common just about everywhere. The exceptions there were like places like Singapore, which doesn't have a massive population, so there are probably a lot of people investing outside of there. But yeah, I agree with the panel so far. Diversification is the key there, and just look at what's happened to the Polish stock market since 1991. There's been a series of run-ups, like big booms and busts, which is that happens in every country, but it has been a little bit more extreme in Poland in terms of volatility. So if you look at that, you'd be like, wow, this country does have a lot more idiosyncratic risk or individual risk compared to the world. So I think for Polish investors especially, it's important to diversify given the history at least.
Okay, thanks. Steven, how about you? Invest domestically or abroad? What would you say?
Well, I would absolutely focus on investing abroad. So I believe it reduces the dependency that everyone has of the country where we live, where we work. Probably we have a property, we have a car, among different items. So possibly we even work in a company that generates most of its business and revenue from the domestic economy. So if a Polish investor decides to go out and invest in Polish companies, he'll just be multiplying his home risk and exposure to the domestic economy, and he'll be missing out of all the opportunities to grow his wealth with just picking up his phone and sending a buy order on a US stock or German stock. So just to name two economies that grow very quickly with strong innovation and lots of improvements being made every year. So absolutely, I would invest abroad, but always try to avoid idiosyncratic risk, as Nick was saying. So very extreme peaks and troughs in the Polish stock index. Absolutely, that would also be a good reason to look abroad.
Okay, thanks. So you actually, all of you agree that diversification is a good thing because we can avoid the situation that the country where we live in have worse period, and we are the victims of the market, of the market decline. So how to diversify equity portfolio? What would you say? Should we buy S&P 500 or American stocks? Or maybe we should buy all world, or maybe we should buy 50% of emerging markets and 50% of developed world.
Yes, of course. So I think if you look at MSCI World, which is always a nice starting point of looking at diversification, the world is sort of divided in the US and then the rest of the world, which is also how I think some of my US colleagues view the world. But I think there's probably more to it than just that. I think if you look at it from the number of listed companies or the capitalization of listed companies, the US is very dominant. But if you look, for instance, at gross domestic product, the world is divided a little bit differently. So my personal opinion is that it's better to basically stay away from sort of the standard geographical diversification and find other ways to more be more aligned to how the world economy is divided and not just the sort of valuation of listed companies. So for me, definitely not just the S&P 500 or QQQ or Nasdaq, but more a much broader approach.
Okay, thanks. Nick, what did you say? S&P 500 or maybe all world?
Yeah, I would pick world. I mean, it's easy to have like, availability bias, like what's working right now. And that's been the US for the last decade, or let's say decade and a half. But if you look from 2000 to 2009, the US was like the worst performing country, right? Of the big countries, right? So you have to see, like, just because we were doing well now, doesn't mean we're always going to do well. And so I think it's one of those things where you have to diversify because you just don't know the future, right? And so right now tech's high flying and in the US, and as Martin said, the Qs are doing well, but we just don't know the future. And so, it's better to be diversified. The other thing I want to say about diversification is only for the good times, right? Like when things go bad, most asset classes will decline together. So like if the S&P 500 declines by, 20% in 2 months, like I guarantee you Europe stocks are going to be down too. Asian stocks will be down. I don't know how much, but they'll be down. It's only during the good times where the diversification actually pays off, where, maybe the US kind of struggles for a decade, but Europe takes off, vice versa, right? So that's kind of where diversification pays off. So you're not going to see it on the bad days. You're going to see it on the good days for over a long period of time.
Okay, thank you. And Steven, what is your attitude to this topic?
Well, I agree. So I believe diversification is key, especially for non-professional investors. So people just need to smooth out volatility spikes, try to mitigate the impact of specific risks, which are always related to, single stocks or even specific sectors, which can be for some reason disrupted, like we've seen before, Amazon disrupting some, traditional retailers. So I do believe it's important for retail to try to broaden worldwide. And I don't believe S&P 500 is the magical solution for everyone. I don't see it as a one-size-fits-all. I tend to see it in some influencers, so some people defending that, well, just send in X dollars or euros each month and it will, magically compound and everything will be perfect. But most people don't have, the risk profile to sustain drawdowns, which are natural in S&P 500. And at the end of the day, as a small investor, you just need to beat inflation, protect your wealth, and have a return higher than deposits or fixed income instruments. So we're not managing money professionally. We don't need to beat any benchmark index. We don't even need necessarily to be the same as the benchmark. So I don't believe it's a magical solution. And at the same time, S&P has a high weighting of technology, about 28%. Even if we account other business sectors exposed to artificial intelligence, maybe that will be even higher. So these are very volatile sectors, and these can generate a big drawdown and possible losses. So I would try to go to worldwide and even add other asset classes to the mix.
Thank you. Peter, how would you build diversified portfolio?
Well, I'm not so pessimistic or negative on the. I think the MSCI World is a good starting point for capturing the better or the market return. I hear what Martin says, and I like the idea of looking at the world from a different angle than market value. But we have to remember as well that the S&P 500, or the U.S. corporate sector, is getting half of its earnings overseas anyway. So it's not, in the old days, equity markets were very domestic. Today, all the major companies and stocks in each the country index is a global company. We have a very strong view inside the way we look at the world from a fragmentation game point of view, which is also the one that is being reflected by the Fed and the central bank, that the world is fragmenting. And in our world, China is uninvestable. So that means that, emerging markets, which China is a very big part of, is not really ideal. So I would start with the MSCI World. It's developed, and then I would basically think about, and that's also what I do personally, think your portfolio as sort of a satellite portfolio. So you capture the market return with the MSCI World, and then you can actually add on, hopefully, some sources of return that could generate more than the market return. Or also, we have to think about, investors are not always completely 100% logical or rational. They also want to be invested in things they find interesting, and that's where the satellite approach come into the picture. So let's say you have 80% in the MSCI World, then you could allocate 20% to thematic themes in the world. I know VanEck has thematic ETFs, so you could add a theme basket on robotics and automation as a play on demographic headwinds. You could add something on software companies, or whatever you feel is a big secular trend. And inside the satellite portfolio, you could even pick some specific companies if that's what you like. And then you can adjust sort of how much you're betting on the market portfolio versus your own ideas or themes. So that's a different way of approaching investing or diversification.
I would say that your approach to this topic is quite similar. You have similar ideas, but these obviously can be really very different depending on who are we speaking with. But there are many people who will say, okay, you say that diversification is good, but it means for us taking a currency risk. If I invest in foreign stocks, I have currency risk because they're in different currencies. The problem is even bigger if we look at conservative portfolios, conservative investors who have mostly bonds in their portfolio, because those should be this should be the stabilizing part of the portfolio. But if we add currency risk, it might be very volatile. On the other hand, if we hold only Polish government bonds, we have single issuer risk. So what would you say? What portfolio should be for conservative Polish investor, or which is better or which is worse, the single issuer risk in portfolio or the volatility? Maybe Nick, maybe you could start this time.
Yeah, so I think as a Polish investor, you're going to have to accept some level of currency risk, especially since, you guys aren't on the euro. If you are on the euro, at least there are funds out there in the US that you can buy that are like euro hedged against owning either US bonds or stocks or something like that. But because you guys are using, I think it's zloty, am I saying that properly? Yep. So because you're using that, I think that's what makes it more difficult. So I would say if you have to think which risk is larger, I would say single issuer risk. Even the US has had problems in terms of all the U.S. bonds, like there was this issue of like, is the government going to shut down? Are they going to be able to pay on time? If that's happening in the U.S., imagine every other country, right? And the U.S. can literally print its own money. It's the world reserve currency. So if there are concerns there, I think there are much more concerns for other, sovereign debt around the world. So that's what I would say. So you're going to have to accept some currency risk. And I don't know if there's a great way around it. People can do things like currency hedges, forward contracts, but I think that's a little too complex for most people. And unfortunately, I don't really know the landscape in Poland to know what products are available that make this easy. But the best one I know is stuff with euro. And as I said, you guys aren't even in euro. So you're going to have to take the risk with the euro or with the dollar. So I would say pick which one you think is better and focus on that.
Okay, so Nick said that he would be more afraid of single issuer risk, if I got you right. Stephen, what do you think?
Well, I do believe for a Polish investor, and given the need and urgency to diversify abroad and get exposure to better growth opportunities, you can and should look to Europe and US stocks and ETFs, and you may consider some currency hedging. So one of the instruments available in Poland is CFDs on currency pairs or spot FX, and that's one of the ways you can protect doing euro zloty or dollar against the Polish zloty, and try to set up a protection for each specific US stock you buy, or overall for your entire portfolio, have some protection to smooth out the currency impacts, as it's a very emerging market-like currency. So to smooth that out. So besides the currency hedging, well, I believe having diversified stock exposure, Europe, Asia, US, but also in terms of investment style. So dividend stocks, value stocks, growth stocks, and for historical reasons, the Polish investors like precious metals a lot. So gold, silver, and also miners, so gold miners and silver miners. So I believe these are instruments that can give some asset class diversification. They can smooth out some volatility. And when S&P is going down and equity is going down, can give you some upside and some protection, and smooth out all the horrible volatility for retail investors.
Thank you, Stephen. Peter, should we be afraid of currency risk?
It depends a little bit on the time horizon, because the shorter your time horizon is, the bigger the potential magnitude for a move in a currency. But there are a lot of international markets where there are also the opposite relationship, where when you have a decline in the currency, you have an opposite positive reaction in the local equity market. I think the Japanese equity market is a perfect example of weaker yen stimulate the export sector. It drives up the nominal value of the Japanese equity market. So, and that's why if you diversify globally and you have a pretty long time horizon as an investor, I would tend to argue that all the different currency risks that you're taking on as a Polish investor will be a zero-sum game. So it will add a little bit of variance to your portfolio, but it will not add any meaningful drift to your long-term expected returns. That would sort of be my naive approach. And I also think it's about if you're a private investor, retail investor, I think it's often about just doing the simple things. And I think as soon as you go into the debate of should I have currency risk or not, or if I should do something about currency risk, it already there begins to be quite complicated, because a lot of different ways you can do it, and you have to pay more fees to do it. So if you're mentally prepared to just have a very long time horizon, then I think actually you'll be pretty okay with taking that currency risk.
Thank you, Peter. Martijn?
Well, I have a pretty simple view on this. I think if you compare the two risks, single issuer and volatility, one of them you can deal with by simply having a long horizon, and one of them actually becomes a bigger risk, maybe even if you have a long horizon. So a single issuer risk is basically the risk that there's a bankruptcy, that you will not get your money back. And if you're dependent on only one issuer or one counterpart or one company, that risk in the end could manifest itself, and it's binary. It happens or it doesn't. But if it does, well, in plain old English, you're screwed. If you look at volatility, obviously it's a little bit uncomfortable if the market moves quite a bit. But if your horizon is 10 or 15 years, then it really doesn't matter that much. And I really strongly believe that you should not get an insurance against it. You should not hedge that. You should maybe deal with it by having different currency pairs in your portfolio, so it will smoothen out. But it's very different. People in the Netherlands sometimes tend to think that it's like a fire insurance for your house. But it's very different, because if your house catches on fire and it's burned down, you have a big problem, because you can wait as long as you will, but it will not rebuild itself. If volatility leads towards an exchange in, let's say, the value of the zloty towards the euro or the dollar or whatever, there is still the possibility that in the end it will sort of resurrect itself, unlike your house. So yeah, I think if I have to choose, I definitely go with the volatility risk. There are ways to smoothen it, and there's also the time that's in your advantage.
You already said that there are different ways to build portfolio, and we can build portfolio using different tools, different ETFs. In Poland, if you look at what is popular, the most popular instruments are global equity ETFs, like developed or developing countries, also gold, ETCs on gold, and multi-asset ETFs. I'm wondering what funds, what ETFs are popular abroad, maybe in your countries, in Europe or in USA, and how do people invest in it? What are the most common mistakes? Steven, could we start this time with you?
Yeah, sure. So I'm based in Portugal, and after some failures in the domestic home market, Portuguese stock index, people, especially the younger generations, are looking more abroad. So US stock market mostly, some Asian companies listed via ADRs in the US as well. So the young investors, the younger generation is absolutely focused abroad. The older generation, so more home biased, more focused on Portuguese stock companies, as we spoke at the beginning. From our experience in the Polish market, we do see some strong demand for precious metals ETFs, so gold, silver, also bond ETFs, so US bond ETFs, exposure to US T-bills and treasuries. So try to have some low volatility instruments with regular distributions, and not so focused on equities or stocks. So try to smooth out all that risk, and also cryptocurrency exposure via ETFs. So I believe those bond ETFs, gold ETFs, and cryptocurrency are the strongest appetite that we see in our Polish clients.
Do you watch statistics of deal broker clients? How do they invest? In which style? Passive way or active way? Do they have a chance to analyze this data?
Yes, absolutely. So our clients are mostly for the long term. So they are mostly investors, not so much short-term traders. So clients who try to build a portfolio for the long term, build some wealth, try to place some money in some hard instruments like gold and Bitcoin and US Treasuries. So we naturally and obviously have traders, but most Polish investors are very focused on long-term ideas, long-term and instruments that can protect their wealth in any extreme scenario that may occur. Maybe for historical reasons, naturally, Polish people are much more sensitive to that kind of occurrence or wars or whatever in terms of extreme circumstances.
Thanks, Steven. Peter, how do people invest in ETFs in Europe, especially Saxo Bank? I don't know if you have access to such data. What are the most common mistakes?
I don't know whether it's difficult to talk about making mistakes in ETFs unless you invest in triple leverage natural gas or an inverse volatility ETF. But if you go with the plain vanilla ETFs, it's very difficult to make big mistakes. I would say that many parts of Europe, compared to the US, we have not had the same tradition as being focused on equity markets, especially here in Denmark, where I'm located. Very much a risk-averse culture. We also have a very big welfare state that sort of empower that. So we have always been a very huge fixed income mortgage bond type of market. But over the years, and I think that goes for many countries in Europe, equities have become more and more a vehicle. The US commercializing and with all the all the media and the great companies that are in the US have really expanded this for a lot of people. And then what have happened in Europe is that the ETFs that really started a big way in the US have come to Europe in a big way, and Saxo and many other of our competitors are offering a lot of, I think, good solutions to create asset allocation portfolios with different risk profiles, and that really helps a lot of investors navigate very quickly. Okay, if I have a short time horizon or I'm really risk adverse, okay, then you go with a high allocation to government bond ETFs or investment grade ETFs, etc., and a much smaller portion in equities. So I think that's really something you see, being powered, by the financial industry, and it's really growing fast. So so I don't see so many mistakes except for the ones I mentioned with triple leverage and inverse VIX, which I think most people should avoid. These ETFs, they have a place in life, but they really for specific intraday or very short-term trading strategies, and it should only be applied by people or firms that really know what they are doing with these instruments.
Okay, thanks, Peter. Martijn, Peter said that it's very difficult to hurt yourself with ETFs. What do you think?
I think he's right. Would have been strange if I did not agree on that, but no, I think he's right. I also really agree with him on the leverage part. I think it's very dangerous. I usually tell people you should invest with money that you can spare, that you don't need. If you invest using a leverage product, you basically invest with money that's not even yours. You're lending it from someone else. It's not a sound strategy, because it takes away the value of time. Because if the market goes down, you can end up being sort of stopped out of your product, and there is no time to benefit from better market conditions because your investment has stopped. So I would definitely not recommend doing any of that. I think the most common mistakes with ETFs, and actually, so you can't really hurt yourself using an ETF, but you can hurt yourself if you start chasing yield. So I think one of the biggest mistakes is people trying to switch from one ETF to another, because they're always trying to find the one that does best, that has the best performance, and usually they look at past performance. And I think by now we all should know that past performance isn't really a good indicator of future performance. So my strong suggestion would be stop chasing yield. Basically, start becoming more buy and hold. And if you really want to sometimes switch, then only switch partly. Maybe add a nice thematic ETF if you think that will do well over the next 10 years. And maybe even start looking at stuff that didn't went so well over the last 2 or 3 years, because maybe it can rebound. So yeah, the biggest mistake is chasing the yield. People should definitely stop that.
Thanks, Martijn. Nick, you are an author of a book, Just Keep Buying, and in this book, you are showing a few common mistakes that people do. What I can also add that the US ETF market is a little bit different than European market. So what are the differences which you can see, and what are these mistakes which you could mention?
Yeah, so the biggest ETFs in the US are generally like total bond, total stock. I mean, like something like VTI or, something with BlackRock iShares. Those are going to be the biggest ones here in the US. In terms of mistakes that people make, I agree with what Peter and Martin said in terms of like, you really can't make mistakes with ETF. It's not the ETFs that's the issue. It's like, why are you buying the ETF? What's the ETF actually doing? And I do think, though, like I'm a little different than the panel in the sense that like I don't necessarily believe in thematic ETFs, because I think it's a slippery slope to go from thematic to yield chasing to inverse leverage or whatever, an inverse ETF or a levered ETF. And of course, these are all on a spectrum. I don't think there's anything wrong with going thematic, even with a small portion of our portfolio. That completely can make sense. But I think like what I've seen in the US, it's like people are all chasing Web3 and crypto, and now that's done. And so now everyone's chasing AI. And so it is kind of what Martin said with yield chasing. It's just there's different forms of it. And so I think people can trick themselves into using a thematic ETF as a way just to getting into the door of what they're actually doing is yield chasing. And so I think it's, people seduce themselves into thinking that they're not doing this stuff, not being long-term investors, when And I think that the key is, buy and hold and just kind of wait it out. And so be broadly diversified, because we just don't know the future. It's so tough to think like right now, of course, AI looks amazing, right? Like everyone agrees on that, right? But because everyone agrees, like prices should have already moved and updated. So it's really tough to think that there's going to be alpha beyond that. So I don't know. I mean, do what you want. Obviously, every person's different. If you think you have an edge, you have more information than others, maybe you can profit off that. But it's really tough to know. And I think that's where people make mistakes, is thinking they know more than the market, which is like a collection of like literally millions of people making decisions.
Thanks, Nick. We are finishing our discussion. And if I could summarize a little bit what we have said, it's worth to go abroad with our investments. We shouldn't be afraid of investing abroad in other countries, although there is currency risk ahead of us. If we invest in stocks, it doesn't change that much, especially in long term. But in bonds, it can be more difficult. But again, I think it might be a smaller problem than single issuer risk, and it's really hard to hurt yourself with ETFs. So you should start with plain vanilla ETFs, which are broadly diversified. And if it's not enough, you should add some specific ETFs, thematic sector, or some other ETFs. And this way you should more adjust portfolio to your expectations. And actually, that's it. It's quite simple, but it often seems difficult in practice. But there is no other way than practice. So thank you very much again for the discussion, and see you next time.
Thank you. Bye.